Let me start with a hard truth. The stock market is not designed to kill you. Crashes don't kill investors. Recessions don't kill investors. Bad news doesn't kill investors. What kills investors is something far more ordinary. Breaking rules they already knew they shouldn't break. Charlie Munger spent more than half a century in the market. He lived through inflation, bubbles, wars, crashes, and manias, and he reached a very uncomfortable conclusion. Most people don't fail because they lack intelligence. They fail because, at critical moments, they abandon discipline. The market doesn't collapse your portfolio overnight. You usually do it yourself, one emotional decision at a time. A little leverage here, a rushed decision there, buying something you don't fully understand because everyone else seems confident. None of these feel dangerous in the moment. That's the trap. The biggest losses in investing rarely come from surprises. They come from decisions that felt reasonable at the time, but quietly violated a rule you had promised yourself you would follow. Munger never believed investing was about brilliance. He believed it was about survival. His goal was not to be the smartest person in the room. His goal was to avoid being the dumbest version of himself. That's a very different game. Most investors ask, "How much can I make?" Munger asked, "How can I avoid ruin?" Because once you're forced out of the market, once you panic sell, once you're wiped out or emotionally exhausted, the game is over. The market doesn't give refunds for lessons learned too late. What makes this even harder is that rule breaking rarely feels reckless. It often feels justified. You tell yourself, "This time is different. I'll just bend the rule a little. I'll fix it later." But markets don't punish intentions. They punish behavior. Munger understood that the real enemy of investors is not volatility. It's human nature under pressure. Fear convinces you to sell what you should hold. Greed convinces you to buy what you don't understand. And ego convinces you that rules are for other people. This is why he focused his entire philosophy on subtraction, removing stupidity, removing unnecessary risk, removing situations where emotion gets a vote. He didn't need constant action. He needed consistency. In this episode, we're not going to talk about strategies or stock picks. We're going to talk about 3 rules. Not exciting rules, not trendy rules, but rules that kept Charlie Munger alive in the market for a lifetime. Because in investing, the first job is not to win. The first job is to stay in the game, and the market doesn't kill you. Breaking the rules does. Most investors believe success comes from doing something smart, finding the next big idea, making the perfect call at the perfect time. Charlie Munger believed the opposite. He said the easiest way to improve your results is not to try to be brilliant, but to avoid doing obviously stupid things. That sounds simple, almost insulting, but it's far harder than it looks, because stupidity in investing rarely looks stupid in the moment. Using leverage doesn't feel reckless when prices are rising. Buying a business you don't fully understand doesn't feel dangerous when everyone else is making money. Ignoring risk doesn't feel irresponsible when the market rewards you for confidence. Most mistakes feel intelligent at the time they're made. Munger understood this. That's why he built his entire philosophy around subtraction. He didn't ask, "What can I add to make more money?" He asked, "What must I remove so I don't destroy myself?" Remove leverage, remove complexity, remove situations where one bad decision can end a game. He knew that markets are unforgiving to people who allow small errors to compound into fatal ones. A single mistake rarely ruins an investor, but repeating the same type of mistake does. Overconfidence, impatience, the need to act. Munger avoided businesses he couldn't explain simply. If he couldn't understand how money came in and why it would continue, he walked away. Not because he thought he was inferior, but because he respected the cost of being wrong. Most investors confuse activity with intelligence. They believe doing something is better than doing nothing. Munger was comfortable doing nothing for very long periods of time because he understood a brutal truth. You don't get paid for effort in the market, you get paid for correctness. And avoiding stupidity dramatically increases your odds of being correct over time. This rule is uncomfortable because it offers no excitement, no ego boost, no stories to brag about, but it works. The market doesn't reward brilliance consistently. It occasionally tolerates it. What it truly rewards is survival, and survival belongs to people who refuse to put themselves in situations where stupidity has leverage. That's why Munger didn't try to win every year. He tried to make sure he never lost in a way he couldn't recover from. Avoiding stupidity doesn't make headlines, but it keeps you alive. And in investing, staying alive is the most underrated advantage of all. One of the most dangerous things in investing is not ignorance, it's false confidence. Charlie Munger was brutally honest about his limitations. He didn't pretend to understand everything. And more importantly, he didn't feel embarrassed about it. He believed that knowing what you don't know is far more valuable than knowing a little about everything. Munger lived inside what he called his circle of competence. If a business fell outside that circle, he didn't research it harder. He didn't force an opinion. He simply passed. To most people, that feels like weakness. To Munger, it was discipline. The market constantly tempts you to have an opinion. Every headline invites you to react. Every new stock story whispers, "You should do something." Munger resisted that pressure. He understood that forced decisions are usually bad decisions. Missing an opportunity feels painful, but making a mistake feels worse and lasts much longer. Most investors don't lose money because they chose badly among good options. They lose money because they played games they never should have entered. Munger knew that intelligence does not expand your circle of competence overnight. Time does, experience does, and humility does. He was willing to say, "I don't know," and then do nothing. That is incredibly rare. Because ego wants action. Ego wants to participate. Ego wants to be right. But the market doesn't care about your ego. It only cares about outcomes. Munger accepted that he would never catch every opportunity. He didn't need to. He only needed a few that he understood deeply and could hold patiently. Waiting is not laziness. Waiting is risk control. This rule protects you from the most expensive sentence in investing. Everyone is making money except me. Munger never tried to keep up with the crowd. He waited for situations where understanding was clear and risk was limited. He didn't confuse opportunity with obligation. Knowing what you don't know keeps you from paying tuition to lessons you never needed to learn. In investing, clarity beats curiosity, and patience beats pride. Most investors believe emotion is something they can manage, that with enough experience, they'll learn when to trust it. Charlie Munger believed something far colder. Emotion is not a tool to be controlled, it's a force to be removed. Fear and greed don't arrive politely. They appear when information is incomplete and consequences are high. That's when judgment is weakest. Munger didn't believe he was immune to emotion. He believed no one was. So instead of fighting emotion, he designed systems where emotion had no vote. If a decision required excitement to justify it, he avoided it. If an investment needed confidence to feel safe, he walked away. He trusted structure over feelings, logic over narratives, time over timing. Most people lose money not because they panic once, but because they allow emotion to make repeated small decisions. Chasing rising prices, selling during drawdowns, doubling down to avoid admitting mistakes. Each action feels reasonable in isolation. Together, they become fatal. Munger understood that the market doesn't test intelligence. It tests temperament. You can be smart and still lose everything if emotion controls your behavior. That's why he preferred businesses that were simple and decisions that were boring. Complexity amplifies emotion. Simplicity dampens it. The more variables you introduce, the more excuses emotion gets to interfere. Munger didn't ask, "How exciting is this opportunity?" He asked, "How calm will I feel owning this during chaos? If an investment couldn't survive panic, it wasn't worth owning." This rule is uncomfortable because it removes drama from investing. No thrill, no rush, no heroic moments, just discipline. But markets don't reward emotional expression. They reward emotional restraint. The calm investor doesn't look impressive in bull markets, but they are still standing when others are forced out. Emotion doesn't make you human in investing. It makes you vulnerable. And Munger knew the safest place in the market is where emotion has the least power. When investors lose money, they usually blame the market. They blame interest rates. They blame politicians. They blame crashes, recessions, and bad timing. But Charlie Munger saw something different. Markets fall. That's normal. That's expected. What's not normal is how people respond. Most investors are not taken out by one big disaster. They are taken out by a series of small decisions made under pressure, using leverage because returns feel too slow, chasing prices because everyone else is winning, buying more to avoid admitting a mistake. Each choice feels logical in the moment. None of them feel reckless. But together, they quietly destroy portfolios. The market doesn't force you to overextend. It doesn't force you to chase. It doesn't force you to panic. Those are voluntary decisions. Munger understood that the real danger in investing is not volatility, but behavior. Volatility is temporary. Bad behavior compounds. Most people think risk means price movement. Munger thought risk meant being forced to act when you don't want to. Forced selling, forced borrowing, forced decisions under stress. That's how investors lose control. The market rarely knocks you out in one punch. It wears you down until you make a mistake you can't recover from. Munger avoided situations where a single bad year or a single wrong move could end his game. He didn't rely on perfect forecasts. He relied on margin of safety, not just in numbers, but in behavior. Room to be wrong, room to wait, room to stay calm. Most investors fail not because they lack information, but because they lack structure. They build portfolios that require constant confidence and constant optimism. And markets don't provide either. Munger knew that if your strategy only works when things go well, it's not a strategy. It's a gamble. The market is not your enemy. It doesn't care about you at all. But it will expose every weakness you refuse to acknowledge. And the fastest way out of the game is believing that losses are caused by forces you cannot control. Because once you believe that, you stop fixing the only thing that matters, your behavior. If you study the investors who last the longest, one thing becomes uncomfortable very quickly. They're boring. No dramatic trades, no constant predictions, no stories about perfect timing. Charlie Munger was one of the most boring investors of all time, and that was his advantage. Munger didn't trade often. He didn't chase trends. He didn't feel the need to always have an opinion. To most people, that looks like inactivity. But in reality, it was discipline. Markets are designed to reward excitement in the short term. Noise feels productive. Movement feels intelligent. But over long periods, excitement becomes friction. Every trade introduces error. Every reaction introduces emotion. Every adjustment creates new ways to be wrong. Munger understood that consistency beats intensity. He preferred a few good decisions held for a long time over many clever decisions made quickly. The most dangerous words in investing are, "This is getting boring," because boredom is often the signal that nothing urgent needs to be done. Most investors lose money not because they chose bad assets, but because they couldn't leave good ones alone. They changed strategies mid-cycle. They abandoned plans during drawdowns. They confused patience with stagnation. Munger never needed to feel busy. He needed to feel right. He understood that the market does not pay you for effort. It pays you for endurance. The longer your time horizon, the fewer decisions you need to make. And fewer decisions mean fewer mistakes. Boring investors don't look impressive during bull markets. They don't dominate conversations. They don't have exciting stories. But they are still standing when excitement collapses. Munger accepted that investing would never be entertaining. He didn't need it to be. He needed it to work. And in the long run, boring is not a weakness. It's protection. The market doesn't need you. It existed long before you arrived, and it will continue long after you're gone. Opportunities will keep appearing. New stories, new trends, new reasons to believe this time is different. But Charlie Munger understood something most investors never accept. The market is infinite. Your participation is not. Every investor is playing with a limited resource, not money, time. You don't get unlimited chances to recover from mistakes. You don't get endless emotional resets. And you don't get to restart once you're forced out. That's why survival was always a priority. These 3 rules were never about maximizing returns. They were about avoiding irreversible damage. Avoid stupidity. Stay within what you truly understand. Remove emotion from decision-making. None of these rules are exciting. None of them promise fast results. And none of them make good headlines. But they work. Markets will rise and fall. Cycles will repeat. And noise will always find a way to feel urgent. The investors who last are not the fastest, not the smartest, and not the loudest. They are the ones who refuse to put themselves in positions they can't survive. Munger didn't try to conquer the market. He designed his life so the market couldn't destroy him. That's a very different ambition. If there is one lesson to take from his approach, it's this. You don't need to win every opportunity. You just need to avoid the ones that can end your journey. Because the market will always be here, waiting. The question is, will you be?